Hey guys, TommyBryson here, and how can you possibly go out there and get a loan? For example, if you don't have any credit, you're new to credit, or for example, you might even have bad credit. In this video, I'm gonna break everything down, for example, from a mortgage to a car loan, or for example, even a personal loan. Just one thing though, okay? Once you learn how to do this stuff, please do not go out there and get into massive debts that you cannot pay back, okay? That's the only thing I ask. And by the way, if you're new here, subscribe to the channel and hit the bell so you're notified when I post a new video. And on top of that, also destroy the like button. And I do post this on the channel every single day. Now, without further ado, guys, let's get right into the video. Now, the first thing is this, okay? Tommy, how can I get a mortgage, one of the most expensive loans ever, without having any credit, or for example, bad credit, or for example, if I'm actually new to credit? Is it possible? Well, the answer is yes. If it wasn't, I wouldn't be making this video right here. Now, when it comes to qualifying for a mortgage, you want to get a manual underwriting done on your entire account, and that way they can actually qualify you based on your entire situation and not just based on the criteria of the entire system. In a way, have you ever applied for a credit card? It rejects you, even though you know for a fact you can actually qualify for it. And when you call in, someone says, hey, I'm a real human, let me review your account. And then boom, you actually get accepted and they overturn the entire decision. That's the entire deal with a manual underwriting. A real person is going to take a look at your financial situation and basically say, hey, you qualify or you don't qualify. And here exactly is the reason why. Not automatically through the entire system. Now, whenever you go ahead and you try to get a manual underwriting, they're going to take a look at three things. And these three things are basically your income. For example, if you make, for example, $10,000 every single year, but you basically want to get a house that costs, for example, $600K, the answer is no. There is no way they're going to give you that money. But if you make, for example, $40K and you want to get, for example, a $200K house and you put down 20%, the answer is it's a lot more likely they're actually going to qualify you for that loan right there, because basically it's only $200K versus a $600,000 home, okay? So your income is also very important. And when they look at this, they want to see, for example, at least 2 years to sometimes 1 year of having a steady job and having steady paychecks actually coming in. Now, the second thing to look at is basically your payment history. Now, if you don't have a credit score, the idea is they can't just look at your credit score and say, hey, you pay on time all the time. That's great. They can't do that. So when they actually do a manual underwriting, they actually basically, hey, can I see, for example, your rent payment statements? Can I see, for example, your utility statements, your bills, everything you actually pay? And with that information, they basically say like, hey, you're actually a good person. You actually pay on time. But that way, it's not based on your credit score, but it's based on what you actually pay for in real life. For example, your rent, your bills, and also your utilities. And that's the entire idea. And the last thing to take a look at is called your debt to income ratio. Now, here's why this right here is so important. Your debt to income ratio basically means how much money you owe versus how much money you actually make and what is the proportion to it, okay? What is the actual percentage? Now, when it comes to a bank or a lender, usually they want to see a 43% ratio. That is the entire idea. Now, Tommy, what is the formula and how do I calculate it? Well, the first thing is this, guys, okay? It's 2020. So all you need to do is just go on Google and type in debt to income ratio calculator, and that way everything is done for you automatically. But I'll do one example here. That way you guys can actually understand it also. Now, the entire idea is this, guys, okay? Say, for example, you want to go out there and you want to buy a house. This house costs $380,000. However, the mortgage itself with interest and capital is around $1,300 every single month. Now, after taxes, for example, insurance and maybe the HOA fees and other fees, in reality, it's going to cost you every single month around $2,000. Now, how exactly do I find out my debt to income ratio? Just using that number right there. Now, it's very simple, and you can actually do it with your cell phone right here. Now, the formula basically says you want to grab basically the amount of money you actually pay in debt monthly, divide it by the percentage, and then multiply by 12 to get the annual income you actually need to afford that debt right here. Don't worry if it doesn't make sense. Again, everything is on Google. You have calculators online, and I'm going to do it right here for you also. So say, for example, you're paying $2,000 every single month for this property. Taxes, maintenance, insurance, the mortgage, everything is included right here, okay? Now, you want to divide it by the 43%. That way you understand exactly how much money you actually require to actually own this property right here. Divided by 0.43, and then you multiply it by 12 months in a year, it means that every single year you have to earn around $55,813 to be able to afford this property right here. Now, you might say, Tommy, that's great. I actually earned that much money. By the way, this is after a 20% down payment of around $70,000. Okay, so again, it's very expensive. And it's actually very hard to even get a house that might cost, for example, $380,000. Now, here's the other part, guys, okay? Because debt to income ratio is not just about the house, but also your student loan debt, your credit card debt, your personal loan debt, your car loan debt. All that stuff right here is going to be taken into account. So say, for example, all your debt, including the mortgage and everything, is going to add up to around $3,000 every single year. Same formula here, okay? $3,000 divided by 0.43 multiplied by 12. That means you're going to need to earn around $83,000, meaning you need to earn a ton of money. And that's why it can be very hard to actually qualify for a house when you actually have a ton of debt. So the answer is here, okay? Whenever you go apply for a loan, make sure to ask for a manual underwriting, and also make sure to calculate everything for yourself. That way you find out, hey, I'm actually going to qualify based on my debt, based on my income, and based on all the factors. And on top of that, you can always save for a down payment, a large one, and that way you can also go ahead, make a down payment. That means we're actually going to be able to qualify for that house a lot quicker. Okay, so always keep that in mind. Hopefully, this right here is helpful. Now, when it comes to the options, for example, you have, for example, a loan broker. Just tell them, hey, I'm looking for someone that's going to do a manual underwriting. That way you're good to go. On top of that, you can always go to a big bank, but ask for manual underwriting. Or for example, Churchill Mortgage, which is a mortgage company that basically does underwriting also very well. Now, those are the options right there. But by the way, if you don't know how to get a loan broker, just call a lot of real estate agents or look online, and you're going to be able to find a lot of them because they're always wanting to make money. So in reality, there are a lot of loan brokers out there that are going to help you with your entire specific situation also. Oh, and by the way, guys, whenever you're actually applying for a mortgage and you're like applying with one bank here, and you worry about your credit score, in reality, as long as it's within 14 to 45 days, all those hard inquiries are going to be considered one, as long as it's for a mortgage, okay? So between 14 to 45 days, don't worry about the inquiries because they're all going to be lumped up together just to one, which is going to ding you by around 2 points for your credit score, and that's about it, okay? So don't worry about like, hey, 2 points here, 2 points here, 2 points here. The answer is no. That's not gonna happen, okay? So keep that in mind also. Now, number two is basically, Tommy, how do I go out there and actually get a personal loan if I'm new to credit or, for example, have a bad credit history? Now, this right here is a little bit more easier and a little bit more complex because basically the price or basically the amount of money you actually want to get can range from $1,000 to $10,000 to $20,000. So in reality, it all depends on how much money you actually want. But for example, if all you want is $1,000 or $10,000 and you're brand new to credit, in reality, they're going to take a look at all the criteria I mentioned before. Basically, how much money do you make? What's your income? And how long have you been earning that money for? Also, how much money do you owe? And on top of that, what is your payment history? Okay, so once they take a look at that, they'll tell you, hey, you qualify, or for example, you don't qualify, and that is the entire idea. However, most likely you'll qualify if you're brand new and you're not asking for a ton of money. But if you do have bad credits and want to get a personal loan, it's going to be a little bit more difficult, especially if it is an unsecured personal loan. If it's secured by something else, for example, an asset, and if you don't pay to take that, the answer is a lot more easier. But for example, if it's unsecured, it's going to be a lot more harder. And if they do basically approve you, it's going to be a very high interest rate because they're taking a risk by actually lending you money. So I recommend, okay, if you do have bad credit score, the idea is you want to pull your credit score and basically see exactly what's affecting it and then go ahead and try to fix that, because basically, even if you do qualify and they give you the money, is going to cost you a ton of money in interest. So also keep that in mind. And by the way, personal loans, I would only get them under a very strange condition. Usually I would never ever get a personal loan whatsoever because it usually doesn't make any sense financially, okay? So just keep that in mind. Now, the last loan is basically, how can I actually qualify for a auto loan to actually buy a car that I actually want? Well, the answer is, well, a car loan is actually a secure loan because basically once you buy that car, if you don't pay it back, they take the car from you. And that's why we have the show, my favorite show, called Repo, where people basically don't pay their loans and they go ahead and they take the car right away from them while they're at work or getting coffee at Starbucks. Okay, it's crazy, but I do like that show, although it is sad sometimes, but it is very dramatic also, which is very entertaining also. But the idea is, okay guys, when it comes to an auto loan, it's a lot more easy to actually qualify for. They're gonna take a look at the same factors again, but the idea is usually they're going to need a small down payment, and that will actually go ahead and qualify you for that loan also. But if you do have a bad credit score, the idea is most likely they're going to try to even approve you even then for example, 5-year loan. You can actually afford it based on your income, but the interest rate is going to be a lot higher. For example, I know someone that has a bad credit score but has a car loan. By the way, I don't know how he got it, but again, it's because he had a job and his job pays him very well. But the answer is he was paying around 16% in interest, and on top of that, he also had an accident with the cops in his car. And the idea is that basically his insurance went up to around $500 every single month. So that car right there was costing them basically like a house in another state. Okay, so the idea is costing him a ton of money, but he loved the car, he still keeps the car, and he still pays a ton of money every single month for that car. So I recommend this, okay? If you have, for example, bad credit, again, try to fix it, and also try to buy a used car for a decent price and ride that car until the wheels fall off, okay? But overall, guys, that's about it for this video. And overall, if you notice here, the entirety is this: if you have, for example, a bad credit score, it's going to be harder, but once you qualify, it's going to be more expensive. If you're new to credit, or for example, you kind of like don't have a credit score, the idea is they're going to qualify you and everyone else basically on your income, your payment history, and also your debt to income ratio. And those are the most important factors when it comes to basically manually underwriting your entire situation to basically approve you or qualify you for a loan. And that's the entire idea here, guys, okay? But comment down below and let me know, was this video helpful in any way? Comment down below, let me know. Any questions though, just comment down below and let me know, and I'll get to it also, okay? I'll see you guys tomorrow. Thanks for watching. As always, if you like this video right here, well, like this video. Also, subscribe and hit the bell so you're notified, and also destroy the follow button on my Instagram at TommyBryson. I'll see you guys tomorrow. Thanks for watching. And if you want to watch another video basically on how to build your credit score fast, well, watch this video right here and click my face right now. I'll see you guys tomorrow. Thanks for watching, and as always, peace.